following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners didn't miss us over our brief hiatus where we took a little bit of a break. It is summertime after all last week, but now we're back in full force and ready for some volatility talk, some volatility action. My name is Mark Longo from theoptionsinsider.com. But I am not a lone voice on the old Volatility Views panel. Oh, no. In fact, it would make quite a poor panel if it was indeed only one voice. But I am joined by the melodious tones of one Don Schlesinger from the Volatility Exchange. Don, welcome back from our extended hiatus.
Well, thank you. We got the week off. You know, guys, Mark is quite a taskmaster. Vacations don't last too long, but we managed to sneak in 1 week there, and I don't know how melodious my tones are going to sound. In the interim, I did some options and derivatives training for my old firm, Morgan Stanley, and it involved 3 days of extensive presentations and speaking, so apologies in advance to listeners if you find my voice a little bit raspy or a little bit deeper than usual. I'm still recovering from the shock of 15 hours worth of speaking in the last few days.
Yes, Don was called up to the majors to do his annual or semi-annual bit of derivatives guruing over at Morgan Stanley. So since you got a chance to check out the new crop of analysts coming into Morgan Stanley, I believe you said it was 100 some odd, so a fairly large crop. Are you enthused for the prospects of the Morgan Stanley analysts this year?
They look pretty good to me. It's a smart group, and you know I can always tell kind of early. You make the assumption because the analysts just come out of not graduate school, but just undergraduate school, so you don't figure they've had quite the seasoning or the background or the training as to when you do what they call the associates, or the ones who are on the verge of graduating from business school and have had higher level courses. But then you get somebody come up to you during the break and talk to you and ask you a question about stochastic volatility and Brownian movement in the Black-Scholes model, and I'm standing there saying, this was undergrad that you took these courses? And I'm thinking to myself, this looks like a bumper crop here, you know? So
sounds like someone wanted to impress the teacher.
Well, that's possible also. And as it turned out, he had something a little wrong about what the assumption was in the Black-Scholes model, but we give him A for effort.
You know, your point about the undergrad is well taken, because there aren't many undergrad programs anymore that really offer any sort of extensive or even cursory education on derivatives. I mean, I was fortunate when I was an undergrad. I went to a school that had a bit of a history in derivatives, and I was also able, because I was a TA in the finance program, to take some courses in the business school as an undergrad, and so I was able to take some derivatives courses there. And that really kind of piqued my curiosity onto these instruments that you could shape and craft into pretty much whatever other instrument you wanted them to be. And that just seemed intoxicating to me, and it lured me out to Chicago, and the rest is history. But not many undergrads, I don't think, who have that opportunity to really study derivatives at length in an undergraduate education. So I suppose...
And you see little of that too, Mark. You're absolutely right. So, this was the one side, but then you see the other side where all of this is pretty much brand new to a lot of the people, and you can kind of see, just the way you just said it, a sort of wonderment in their eyes as you tell a few war stories, or you talk about, how options work and the things you can do with them. And one young lady said, just that, boy, this sounds like fun. I really like to trade these. And I said, well, we have the simulated trading exercise at the end. At least you'll get a taste, a little, sampling of what it might be like. But that actually in itself was kind of encouraging and nice to hear that she was enjoying and sort of like getting taken up in the whole thing. But it just points out what you said, that for a lot of people, at least on the undergraduate level, there really is not much exposure to any kind of courses that are specialized enough to actually treat derivatives or options.
Yeah, I'd imagine for the bulk of the people in that class, your presentation was really their first and only introduction to derivatives products. And I guess that girl, she liked it. She caught the fever, so to speak. We'll see if the rest follow suit. Of course, you said this was a 5-week course, part of it, and yours was 3 days?
Yeah, I think the training sessions there for the summer typically run 5 or 6 weeks, and what they do is they introduce them to every possible aspect of the business, and it's really very time intensive, probably from 7:38 in the morning until 5 in the afternoon, and they bring in speakers internally. I'm sure all the big investment banks do this. My familiarity is with the Morgan Stanley program. And then so, we've carved out a little 3-day snip, if you will, in the overall training, and they kind of set aside those days for me, and we do the derivatives training.
Yeah, it's nice. I mean, of course, given the complexity of the products, you'd hope they would devote a substantial portion of the 5 weeks to them. But I understand derivatives is not the main focus of the course, so it's nice that they at least give 3 days to that. That's more than a lot of certified financial planners and others who are ostensibly the gatekeepers to a lot of the wealth of this nation ever have when it comes to derivatives.
Well, it's funny because they're so time intensive and it's so cram packed that really what I do easily could take more time, but they just don't have it to give. And sometimes they ask me to coordinate with some of the other instructors who are part of the program. Some of the stuff they outsource, some they do internally, and they want us to all sort of be on the same page so we don't step on one another's toes or duplicate materials. And so when I spoke to one of them before this year's sessions, he said, well, just give me an idea for what you're doing. And I started running down, all of the topics and all the modules and everything. And he said, you do that in how many days? As if to say, that sounds like about a week's worth of material. And I said, well, you're right. And the administrator of the program was on the conference call also. And I said, hint, maybe we need a little more time for this going forward. They always kind of promise they'll carve out a little bit more time, but somehow or other, I never seem to get it.
Well, I don't envy your task, having to go from essentially what's a call, what's a put, all the way up to volatility skew and concepts like volatility in the course of just a few days. It's quite the ramp up.
Yep, it's exactly what it is. So kind of fun. It's a challenge.
Well, speaking of volatility and volatility skew, that is what we do here on this show. That is our purview. So let's get right into it with our volatility review.
It's time for the Volatility Review.
All right, and welcome to our Volatility Review. And listeners, we are recording this at our normal time, so noon Central here on Friday, and it is, of course, the day after that big debate, that big vote was postponed last night, and we discussed this at length on the option block yesterday about what that vote would mean for the markets and for broad volatility coming into today, if it passed and if it didn't pass, if it was postponed, and that was the case, that it was indeed postponed. And now, a little bit after noon Central here, we're looking at a a down day in the markets and a corresponding up day in volatility. Right now, the S&Ps are down about 6 handles to 1294, or 1295 roughly, and the Dow is down about 73 to 12167. The Nasdaq down about 5 handles to 2760, and the VIX cash swinging to the upside, up 1.87 points, or about 8% to 2561. And Don, have you been following this debt kerfuffle going on in Washington? I suppose it's kind of hard not to at this point.
Yeah, I certainly have, and obviously it's roiling and rankling the markets a little bit, as can be expected. There was a couple of days in there where people were commenting, and I was as well, that actually the markets were kind of taking this rather well. Not that they were going up, because they weren't, but simply that if we did have this impending catastrophe that everybody was truly fearful of, that you might have thought that the damage this week would have been even worse. So I think that there's some realization on the part of market participants that an awful lot of this is political posturing and this rather high-level game of chicken that's being played. So we'll see what the weekend brings, and we'll see what the first 2 days of next week bring.
Yes. Well, if you're looking, it always makes me nervous, and I said this on some of our other shows recently too, when financial analysts become armchair political analysts and vice versa, and everyone's crossing their streams, so to speak, and suddenly we have everyone's playing in everyone else's pool, when they really probably it's not their area of expertise. But I know on the recent show yesterday, we were discussing what would happen if this vote was indeed put off. I kind of tended towards the non-event part of the spectrum. Some of the gloom and doomsayers were thinking down 25, 30 handles in the S&P. Looks like we're hovering around the non-event portion of that spectrum at this point. And among those gloom and doomsayers was, surprise, surprise, our own volatility pit reporter, good old Mark Sebastian from OptionPit.com. Mr. Sebastian, Mr. Seabass, what are you watching here? What have you been seeing in your volatility pit report, especially now that the gloom and doom scenario, the gloom and doom prediction has not come to pass, at least not yet?
Thanks, Mark. Happy to be here. Well, today is one of those days where implied vol, realized vol really, really kind of disconnect. And actually, realized vol interpreted is kind of disconnected as well. So this week has been one where we've seen, we've had a couple days of real market movement, but for the most part, it's been a rally in implied volatility. We've gone from 19 up to over 25, and that's because of the market's fear of what's coming, not what is actually happening. Now, at the same time, we do have that little disconnect. For instance, Friday, we ended up down 8 handles. Well, guess what? We actually had a intraday range of about 24 points. So I think we were up 6, and we were down as much as 18 handles. So it was a really, really wide range. But realized volatility doesn't necessarily pick up on that. That's one of the interesting things about realized volatility. So one of those really weird ones on the kind of VIX future side, one thing people have noticed on Friday is that their VIX options will have lost money. Well, guess what? Futures sold off even as the VIX was rallying. That's because people are expecting a deal this weekend. So that was my week in review.
All right, and thank you for that, Mr. Sebastian. And Don, of course, we cover the full spectrum of volatility and volatility products on that show, and that includes the ever-popular Euro vol contracts trading over there on the CME. And so, Don, what have we seen over the past few weeks here in Euro vol? Are they playing in any way commensurately to what we're seeing out here in the broad market with the concerns over the debt and the pending shutdown, the pending default?
Well, what's interesting is if the listeners remember, not that I get that many forecasts right, but I do kind of recall from about 2 weeks ago that we were at an unusually high level, very close to 14 in this front month August Euro vol contract. And I simply took the rather simplistic approach that looking at our vol cones, looking at the Volatility Institute forecast for future vol that seemed like a pretty high level and one that perhaps wasn't going to be sustained. So I went out on a very small limb a couple of weeks ago towards the end of the show when we do our outlook or forecast or crystal ball. And I think I remember saying that I probably play this to the downside in the immediate future. And I'm just looking at the graph, and darned if almost the very next day this thing seemingly fell off a cliff, and we went from a high of about 1390, which was on the 12th of July, and by the 25th, which was almost the 2 weeks later that we've been off the air, we were down to 1167. So that was a considerable sell-off. In answer to your second question, yeah, there's been a little bit of a pop. I don't know if it's because of the debt ceiling impending crisis, but off of the floor of that 1167, we've now rebounded and settling in the low 12s for the recent pricing. Actually, 1204 was last night's settlement. So we will see how this plays out. There's 6 days to go in that front month. It's tough to say from here what the direction might be, so I might be jumping ahead to our crystal ball segment, but right now it's anybody's guess what these next few days will bring.
See, Don, if you had only followed your own advice, you could have added yet another gardener to your palatial estate there in upstate New York.
Yeah, well, you get it every once in a while, get it right. Even a blind pig finds some truffles every now and then, so.
Well, I think your record is a little bit better than a blind pig. I will give you that compliment, sir. But with that lovely image in mind, we will close up the volatility review and we'll roll right into the volatility viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
And welcome to the Volatility Viewpoint. This is indeed the portion of the show where Don and I sometimes bring on a guest and sometimes Don and I discuss some of the interesting and unusual topics that are floating around the world of volatility. And this is actually, we have a good opportunity this week because Don, as we discussed in the intro, just came back from his mega session with the Morgan Stanley analysts last week. And he had a chance to get some firsthand input, some firsthand questions, some firsthand commentary from people who are either slightly versed in options or I think for the majority of them, that was their first exposure to the world of options. And we've touched on this show in the past briefly on the topic of skew. And I think now that Don is ripe from his classes in Morgan Stanley, it's a good time to get back into this topic because there are a number of questions surrounding it. We receive a number of questions on this program on a regular basis about skew. And I know, Don, you had your hands full when you got to that chapter in your presentation about skew and not just the different types of skew like investment skew or commodity skew or vice versa, but also some of the reasoning behind this phenomenon and why it actually occurs. It's a fun topic. I've discussed it a number of times on various articles and webinars, and it's fun because there are some concrete reasons behind it, and there's also some subjective ones as well. I think we can get into both of those. But since you are fresh from the Morgan Stanley educational marathon, we'll let you start off with some of your reasons you think why skew exists and the different types of skew that we're seeing out there in the market right now.
Well, of course, the interesting starting point for all of this is that prior to the crash, there really was no skew to speak of, at least in the form that we know it today.
No, it's an observed phenomenon. We didn't know it until it hit us in the face.
So we kind of touched upon it in previous shows where prior to the crash, you really had a kind of a flat one vol fits all, below the market options, above the market options, puts, calls, and there was a kind of a slight upturn at the very extremes, very far out of the money calls or puts, and something referred to as the lottery effect. I'll touch upon that in a moment. But in any event, when you connected all the dots, if you will, you had what looked like a smile, and it came to be known as the volatility smile. And the literature still kind of mentions that, even though, as I kind of ironically say, that on October the 19th, 1987, the smile was wiped off the face of options probably forever. So it was replaced with this, at least in equity, and we can talk a little about the shapes of other ones, but at least in equity with this asymmetrical smirk or skew, if you will, where the out-of-the-money puts and the in-the-money calls, the options below the market, are at progressively higher implied volatilities as we go further below the current levels, and just the opposite to the upside, where increasingly higher strike prices seem to give you increasingly lower implied volatilities. And so you have that kind of asymmetric pattern. And the question, of course, on everybody's mind is why? And there are numerous answers, and some of them, as you said, are subjective, some of them are objective. I've always kind of argued that from a strictly mathematical point of view, absolute, just trying to apply any types of formulas, distribution patterns, justification for prices, that I find it very hard to justify the way this current implied volatility skew looks if you're just going to invoke purely mathematical concepts. And my strong feeling is one of supply and demand that drives these prices even to this day, and I'll touch upon it in a moment. But there are other suggestions, and I'm going to kind of offer them and then kind of rebut, if you will, or try to explain why I don't think they're necessarily valid explanations. So the first one is this lottery effect. And the lottery effect simply states that if you can get a tremendous payout for something, a huge multiple, basically pay an eighth of a dollar or a quarter of a dollar for an option that's way out of the money, and if something untoward happens, wind up making millions if the option goes to $20 or $30, that anybody is willing to pay a little bit more for this lottery ticket. Everybody who goes and pays $1 to buy a lottery ticket and hopes to make multiple tens of millions of dollars doesn't bother to figure out whether the government or the state that runs it is keeping 50% and that the true price ought to be 40 or 50 cents, but we're paying $1. So, in implied volatility terms, we're overpaying for this. But that doesn't stop people from going out and buying their lottery tickets every week. So the concept there is simply that, so if you pay a little bit more, if I pay 20 cents for the option instead of 10 or 15, what the heck's the difference if I can have this huge payout? And there's nothing wrong with that argument, except for the fact that if that were the sole explanation of the skew, you'd wonder why it's not two-sided, why there isn't at least some semblance of more symmetry to it. Because although it's true that we've seen markets go down 23% in one day, but we've never seen them go up 23%, at least in the equity markets, then it might be reasonable to say that the jackpot, if you will, or the big payoff is slightly skewed to the downside, and studies show that downside volatility, when it's separated from upside volatility, is slightly greater, but with the emphasis on slightly. So my point of view there is that, yes, the lottery effect could explain higher implied volatilities for extremely out-of-the-money options, but it ought to do so more in a two-sided fashion, such that if there were a huge increase in the underlying, you could have a lottery effect there as well.
Yeah, you'd think that I've heard a lot of different propositions put forth for why skew exists, but the lottery effect is not one I've really heard that often, at least recently, because you'd think just looking at the skew graph, it would instantly disprove that notion, because you're right. The skew graph, at least when it comes to equity/investment skew, is asymmetrical. You're not seeing this increase in the wings on both sides. You're seeing the decrease in the call volatility, obviously, and the corresponding increase in put volatility. So that would imply that everyone is betting on the lottery tickets to the downside, which would be a unique phenomenon given the fact that everyone in the market usually tends to lean quite long. And unless they're all hedging and over-hedging quite a bit, I don't know if that lottery hypothesis really pertains.
And I agree with you, of course. So again, I'm not the one who invented it, but rather am commenting on it, and I absolutely share your viewpoint. And a second related one to that I discussed somewhat, and that I come to a similar conclusion about, is that maybe the model that we're using in order to derive these implieds in the first place, because don't forget, implieds don't exist in a vacuum on their own. You have to first price an option and then work the Black-Scholes model backwards to back out an implied volatility. What volatility did we have to use in order to arrive at that price? So it's a kind of a backwards process where an implied doesn't exist without first having an options price and then using the Black-Scholes model kind of backwards from the way it was intended to be used, where you input a volatility and then get as an output the price of the option. So one of another argument is that the model is imperfect, and we know that the Black-Scholes model is imperfect for a number of reasons. It assumes a constant volatility. You enter one volatility, and then you price the option for its life as if that volatility is going to stay the same over the entire course until the expiration. And of course, we know that that's not true, and we've talked on the show about the volatility of volatility and how much it moves around, especially in the short term. And yet, when you go to an option pricing model and they say stick in a volatility, that's one number that you provide as if that number were going to stay the same all the way through. In addition, you know that in the Black-Scholes model, you take a look at it and it says it's the normal, the area under the cumulative density curve, the normal of, and then there's an expression D1 minus the normal of, another expression D2. And when you look at that, there's an assumption of this log normal distribution of stock prices. So a second argument is that we kind of know from observation that that's not really true either, and that stock prices, at least again, with equity, exhibit what we call in a very fancy term leptokurtosis, or fat tails, and that the outliers on both sides, yet again, that's the key, up and down, that there's more area under the curve than the normal distribution would allow. And so again, it's an argument for perhaps raising the prices of these out of the money options as an accommodation to the fact that we have fat tails in the real world and not the perfect, normal or log normal distribution. But again, my rebuttal to that would be quite simply that this again is a two-sided phenomenon, and that when you look at these fat tails, it's in the plural. You find that they're on both sides, and that both to the upside and the downside, you find more outliers and more area under say 3 standard deviations up or down than would be predicted by the classic normal distribution or bell curve. So again, it's a valid phenomenon, but in my viewpoint, it doesn't describe or doesn't adequately explain the shape of the skew, because yet again, as you just pointed out for the lottery effect, it ought to be two-sided, and it isn't.
I can't imagine. Obviously, I know you're just running these down for our listeners, and like you did for your students last week. But I can't imagine any serious trader at this point would look to the old fat kurtosis, because again, the equity skew asymmetric, so you need something that could account for that asymmetric style of shape. Of course, I'm sure a lot of the premium sellers in our audience would love to have fatter tails on both sides of the skew, because that would just mean a bonanza for them as they continue to hit these out-of-the-money options with great fervor and vigor. But it seems that is not the case, at least not for now.
So then there's one more, and then I'll kind of get to the supply and demand part to wrap up this segment. And the one that I think you will admit, Mark, that you have heard, because I certainly have.
I will admit nothing.
Okay. is also, in my opinion, somewhat flawed, and I'll explain why. And that is that people say, well, that volatility might look high. We might be at 20, or in fact, we're at 25 right now for the at the money as volatility has been spiking. But as you go below the market, you start to see 28 and 32 and 35, and you might even hit 40 if you go down far enough. And so the argument goes, it's not my argument, but I'm repeating it. Yeah, I can understand that, because if we were to drop today to those levels, and because they're down 10 or 15 or 20%, and my gosh, if we had a meltdown and the market were down 10% today or 15% today, by all means, those options would be trading at those implied volatilities, if not even higher. So we're justified in saying that if we go 10% or 15% below the market, because if we had this, catastrophic event, that would be the level of volatility at the time. Well, that may very well be true, but it sure as heck does not explain, in my book, why you would take that volatility that you think we would be trading at the moment and trade it every single day of your life as if we were actually already there, without discounting it at all for the probability or the likelihood that we could ever be there. I think I once calculated earlier in the year, so listeners can check my math, but since the crash, October 19th, 1987, I don't think it's quite 9,000. I think it's about 8,700 days have gone by, okay? Now, that may not be trading days, so that may be something more like calendar days in the year. But I think that if you go back and check, we probably had something like about 6,000 trading days since the day of the crash, somewhere in that neighborhood, okay? And to imply, no pun intended, to imply that each and every one of those 6,000 days that we go out there, that we should be thinking, today's the day that we're going to be down 10 or 15%. So we need to trade these options at 40, because after all, if we get there today, we'll be at 40 or 50 volatility. Well, I mean, at what point do you stop thinking that way? At what point do you stop waking up in the morning and going to work on day 6001 and say to yourself, you know what? We probably won't be down 10% today. And I probably shouldn't be trading those options at, 40 or 35 implied volatility. Nobody wants to seem to calculate in the probability or the likelihood that we could be at 40. So now if you give me a weighted average, 40 with what probability? 1 in 1,000? 1 in 2,000? Now multiply out and do an expected number or an expected value, and I don't think you're going to come up with 40 anymore. So that's just not an argument that sits well with me. I'm just not willing to buy that one.
Yeah, that one's almost like a battered wife syndrome. You keep getting hit every day expecting something different, I suppose. So, of course, given the rate that many market-making firms and trading firms are shuttering their doors these days, maybe there are more adherents to this philosophy than you think, though.
Yep, well, it's very possible. And so, of course, you've got to get some explanation. And the one that I've always subscribed to, just because it seems by far the most logical to me, is supply and demand, and is the fact that something is worth what somebody else will pay for it. And we know what a debacle portfolio insurance was at the time of the crash, where firms were selling this concept of trying to dynamically replicate the protection that a put option would give by instead selling off futures contracts as the market would move, and if it would drop, you'd sell some more. And we discussed that at another time as well. And of course, what happened on the day of the crash was that they didn't get off all of those sales, according to their wonderful schedule, because the futures dislocated from the cash, and all of a sudden down 20% without all of the intermediate sales that were supposed to take place, and tens of millions of dollars were lost. And so this concept of dynamic put replication was discredited and kind of disappeared from the landscape. And as a result, we went back to the good old-fashioned have the protection in your pocket ahead of time, have these sleeping puts and insurance puts, and don't try to protect your car from a crash as it's going over the cliff, but have your insurance policy in hand ahead of time. So these puts below the market simply became the gold standard for equity portfolio protection. And the sellers, who might have been burned on the day of the crash, basically said, fool me once, shame on you, but fool me twice, shame on me. And they resolved to never sell those puts at those lower implied volatilities again. So to my way of thinking, it is a supply and demand issue. It's not something that can be justified from any mathematical or rigorous analytical point of view, but simply one of expedience, where the owners of equity and the natural, inclination is for portfolio managers to be long stocks and to go out and have to occasionally protect. And they do so by buying these puts, and the sellers say, aha, you can't do it any other way, and I'm going to make you pay through the nose for this. And the final piece of the puzzle is, as it gets expensive to do this, the buyers, the needers of the insurance say, how can I possibly cheapen this up? And the answer is, well, maybe I look above and I sell some calls, try to offset the cost of this premium by taking in a little premium to offset the pain a little bit, if you will, the price of the protection. And so was born of the crash this skew where the below the options driven by the puts got more expensive, and the calls that were being sold to offset the cost got cheaper, and I think it's going to be forever thus. I don't think we're going to see any change. I never thought that would have been the case 25 years ago, but I definitely think it's the case now.
Yeah, I don't see us going back to the smile anytime soon, as much as some people might like it.
The pre-crash smile is wiped off the face of options forever.
There you go. You're very fond of these dire pronouncements, like the smile being wiped off, or the options die a little every day. Of course, they make for great show headlines, titles. So I love them. And the way I've always discussed skew when this topic comes up, and it comes up quite a bit, as you could imagine, I approach it from a fundamental and a psychological perspective. And they all seem to key around that factor that you pointed out, that the bulk of market participants are at any given time long the market. They're long the underlying. So that causes several effects. On the fundamental side, I mean, anyone who's ever spent any time in any large equity option pit knows that the bulk of the order flow coming in from the large customers, the institutions, what have you, because most of them are long, let's say a Microsoft or an Intel or a Google, these long institutions are dumping covered calls all the time, so therefore crushing the upside skew because they're trying to generate income from that long portfolio. At the same time, they're looking to hedge their downside risk with that long portfolio, hence they're buying up the downside puts, so that tends to give the skew that asymmetric tilt that we like to know, where the upside calls have a decreased level of implied volatility and the downside puts have an increased level of implied volatility. And of course, the opposite side of that, which would be the psychological aspect of that, of course, also comes from the fact that the bulk of market participants are long the market. So when we rally, there is a generally reduced level of fear and or uncertainty in the marketplace, and when we crash, when we move to the downside, there is generally an increased level of fear and or uncertainty because people are suddenly incurring losses in their portfolio. So I think when you merge those two factors together, the fundamental and, of course, the subjective/psychological, then you have what we've witnessed for the last 20-odd years, or the 6,000-plus trading days that Don has referred to, the good old asymmetric equity skew that we all know and love and or hate.
I agree with every word that you said, Mark, and you just kind of wonder whether or not, for, 14 years, they introduced options in 1973, and then along came index options, and basically you just wonder whether or not, people for those 14 years were considered to just be kind of like trading in the dark ages, or, were too dumb to figure out or understand any of this. And I kind of say that a little bit sarcastically. Whereas I agree with absolutely everything that you've said. It's sort of like it took the crash to actually put this idea into people's minds, as if the exact same concepts didn't exist prior to 1987. We had portfolio managers long the market, and we had put options long before, well, not long before in a relative spectrum, but, 10 years before the crash, and yet this didn't occur to anybody. So the question remains whether it's not somewhat overdone or not, but we don't want to beat a dead horse here.
It's interesting. Of course, you predate the crash in the options markets. You have a dual perspective. I came into the options market post 1987, and I think anyone who did that, there is definitely a demarcation in the world of options where people who came in afterwards, and the resulting just upheaval that has occurred in the technology and, of course, the knowledge and understanding of how the underlying and the options perform in these extreme events, that people do kind of consider the pre-1987 days, the pre-skew days, they look a little bit askance, those are indeed they are the dark ages. I've heard quite a few people refer to them as that. Perhaps not quite as dark as the days when there were no puts, when people were just trading in the ether, as it were. But still, there is definitely, if you look at options education and options training, there is a demarcation where here's the days back in the dark ages, and here's the days after this event where we started to get it a little bit more, and we started to understand what the heck was actually going on. Maybe we still don't have a full handle on it, obviously, but perhaps a tighter grasp than we did prior to 1987.
Yeah.
All right, that was a fun discussion. I think we could go on about skew for quite a long time, but we do have to close out the old volatility viewpoint. And I know a lot of you have written in. We have a lot of questions and emails that are lighting up our mailbag and keeping Don quite busy on the old forums. But we did go along a little bit with that skew conversation, but we'll get to your questions and comments in an upcoming show. Don't you worry. So now we're going to roll right into our crystal ball segment.
And now we take a look at the crystal ball.
And welcome to the Crystal Ball. This is the portion of the show where we tend to prognosticate wildly, irrespective of what we actually think or what is actually going on in the underlying markets. No, I'm just kidding. But we do tend to gaze into the murky ether of the future here, and that's a easy and or terrifying thing to do right now, given the definite, almost literal, palpable weekend risk that we have this week. We talk about weekend risk a lot on this show, and this is a weekend when there is quite literal anything could happen at any point during the weekend. So if you are long substantial positions and you don't have any protection, or you are, then maybe you might want to reconsider that. Or if you can, then perhaps it's a good weekend to sit one out and close out your long positions and see what happens, because like I said, anything could happen. As we're finishing up the show here, we're starting to rebound a bit in the markets. The VIX is coming off a bit. It's only up about 1.3 now, and the broad markets are starting to rally. S&P's down about 2.5 handles now, so perhaps the worst is over for us on the day. But like we said, there is still a lot to come on Saturday and Sunday as the debate rages in D.C., and of course Tuesday is the actual deadline. So there is a lot to come in the coming days. And speaking of the coming days and what is on the horizon, we'll kick it off with our volatility pit reporter, good old Mark Sebastian from OptionPit.com. Mr. Sebastian, what has you up at night these days? What are you watching in the world of volatility and volatility trading for the coming sessions?
Coming up, my forecast is as follows. If they get a deal done, which I think they're going to get done, then I'm expecting realized volatility to be much higher than implied volatility over the next couple of days. I'm expecting implied volatility to be sold off aggressively, and I'm expecting realized volatility to really move up. I think we're going to get a big rally, and a good debt deal could actually get us finally through that 1350, 1360 level. So that is my forecast going forward.
All right, thank you for that, sir. And because the world of volatility does not end with the S&P 500, there are indeed other products with volatility that are trading quite actively, and we'd like to cover them all, including the good old Euro vol contracts that are lighting up the tape these days over at the CME. And Don, I know we touched on it a little bit in our volatility review, but what is your outlook? What are you betting the farm on this week in the Euro vol contracts?
Well, I'm going to chicken out and take a pass on betting the farm just because of what's been going on.
Maybe just bet the guest house then.
Yeah, we've got a pretty crucial weekend coming up here that can affect all markets across the board. So obviously we did have that drop that I alluded to earlier. Now we've kind of bounced a little bit, and just depending on the outcome of the debt ceiling discussions, we obviously could be in for even more volatile times. Or if this resolves itself, as I think it's likely to, then we could have further abatement, not only with the euro, but then again kind of circling back even to equities. And it's kind of interesting that you mentioned that as we were speaking, the VIX was kind of selling off a little bit, because if you go to, for example, the volatility cones that we have on the website, volex.us, and you look at the current levels where we're at 24 or 25% on the VIX, of course, that's implied volatility, not historical. But I'm looking at short-term volatility over the last year or so for the S&P 500, and you can go back even longer period of time. You realize that to get up into those levels, you're talking about the 70th or 80th percentile, which is to say that the vast majority of time, actual or realized volatility is lower than the levels of implied that we're seeing right now. So if this thing does get resolved, or there's any type of indication that it will over the weekend, I think you're likely to see VIX come off rather dramatically, and perhaps other commodity volatilities as well.
Yes, I know quite a few people who are leaning to the downside these days in VIX and good old VXX, and betting for a sharp downturn out there. Of course, there is a lot of room for vol to go down right now. If you've been watching some of the weekly options that were just listed yesterday, there is serious premium built into these that there is going to be a significant event this week. We even have some high beta equity options, some of them which had earnings this week, which you would think post-earnings that would deflate the level of front-month vol trading in these names, and yet some of them are still trading at or near earnings levels of volatility, even though the earnings have passed, because there is so much uncertainty about what's coming up into the weekend and indeed on Tuesday. It's like we have a second earnings cycle for a lot of these names right now, which I think a lot of people who are traditionally going the short premium way into earnings are a little dismayed by that they're not getting the payoff post-earnings that they may have hoped for. They have to wait and hold it through the weekend, take the weekend risk, and then hopefully not, but perhaps even hold it into Tuesday to see what comes out there. I tend to lean with you, Don. I think there will be some sort of agreement of some type before Tuesday, perhaps over the weekend. Of course, it'd be nice if these types of things could actually work out, not down to the wire. Someone could actually, pretend to have some fiscal responsibility in the year or two leading up to these types of events. But what fun would that be?
Yeah, we're gonna get right down to the wire with this one. That's pretty clear.
Yeah, and we have no political leanings, no political pretensions on this show. We think everyone down there in D.C. is equally guilty on this one. There are no good actors on this.
Equally incompetent right across the board. It transcends political parties.
That's one thing. If there was an incompetence index, I would always lean long that one, because that's one thing you'll never be surprised at in D.C. is the level of incompetence. And with that somewhat depressing note, we will close out this episode of Volatility Views. I do want to thank my cohort, my partner in crime, the yin to my yang, good old Don Schlesinger, for joining me on the show today and soldiering through despite the fact that he just finished a marathon seminar of derivatives education for the folks over at Morgan Stanley. And I hope those kids right out of school appreciated it, Don.
Well, it's always fun for me to get back, and it keeps you young, that's for sure.
Did you have a chance to recommend the podcast at all during those 3 days?
Actually, I did, and we talked about the fact that, not only the Volatility Exchange and the fact that we have our website that has a lot of information, but I mentioned that I've been having a great time doing the radio show and where they could find it on Options Insider, so I hope you'll win a few converts there.
Yeah, we have seen some an influx of people, so maybe your word of mouth is spreading. And of course, we will make it even easier for our listeners to subscribe to this show going forward, and indeed your future students, Don, because fans of the Options Insider Radio Network will know that we just added a new feed for the Option Block in iTunes, so you could subscribe to that individually if you like, and search for that, which is nice, in the iTunes store. And we will be following suit with Volatility Views very soon. Once we get the old cover art finalized, then we will submit that new feed, and you will be able to go in and subscribe directly to Volatility Views and search directly for Volatility Views. You won't have to find it in our network feed, so that will make it even easier for people like your students, Don, to find the show going forward.
Sounds exciting.
It's everything we do here is exciting, Don. And of course, listeners, if you want to get in touch with us on the show, by all means, surf on over to theoptionsinsider.com and then click on the forum section where you could scroll on down to the Volatility Views listener questions section and post your questions there. You can also send us questions via Twitter, twitter.com/options, or twitter.com. I believe yours is volex_info. Is that correct?
Yes, it is.
Okay, so you can send us Twitter questions via those addresses. Of course, you can also find us Options Insider on Facebook and even leave us a voicemail, 312-544-9356. There is no shortage of ways to get in touch with myself or Don. You can also email those over to Don, info@volex.us. Just put Volatility Views in the subject line so Don knows it's going straight to him. All right, that's going to do it for this episode of Volatility Views. I want to thank all of you out there for downloading and streaming and subscribing to this show and helping to propel the Options Insider Radio Network up there into the rarefied strata of the top 20 in the iTunes business charts, and hopefully we can stay up there for a long time to come. But thanks again for listening, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about VolContracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.